Welcome to Illuminati Silver. We tell her the truth about silver. Today is Monday, the 7th of March 2022, and we're publishing part one of a two-part interview with Mr Josh Saul, the CEO of the Pure Gold Company, which is located beside the Bank of England in London and specialises in gold and silver investments. Josh very kindly undertook an interview with us on Friday and generously gave us an hour of his time. We discuss his business, why gold and silver are important for wealth preservation, the interrelationship with other investment vehicles, the gold and silver ratio, and why, in his view, silver should be $100 an ounce, even with gold at the current price level. We've decided to split the hour-long interview into two parts, with part one published today, part two tomorrow, and then on Wednesday the full interview. It is packed with useful information, especially as the Pure Gold Company has clients from around the world. And for those interested, we've included a link in the description box below, as well as in the comment section of each video. So let's now see what Josh and his business is all about, and what has happened to gold and silver as an asset class. Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday, the 4th of March, 2022, and it's 3 p.m. in the afternoon. And I'm delighted to have Mr. Josh Saul, the CEO of the Pure Gold Company, with us today to tell us about his business and what makes them particularly unique. But first, I'd like Josh to tell us a little about himself. Josh, good afternoon to you.
Good afternoon. Thank you very much for having me.
Tell us about you and then about your business, Josh, just so our members can get a sort of flavor as to what you're all about.
Perfect. I'll do my best.
Thank you.
So I trained as a lawyer back in the day before becoming a financial analyst, analyzing metals and mining and various companies across that sort of sector. And that then took me to getting involved in the physical market. I ran a brokerage within the UK for a few years before setting up the Pure Gold Company in 2012. I live in London. I have two young children, happily married. And as much as I like to involve myself in all things gold and silver, I also like to travel. I like to read, and I like to educate myself in terms of what is happening within and around the world, and how we are able to proactively make a difference and make a change, both for ourselves and society.
That's great. Thank you, Josh. The Pure Gold Company, what is it and what do you actually do?
So the Pure Gold Company is a company, a physical gold and silver brokerage with a particular emphasis on investment. So we sell physical bars, gold bars, gold coins and silver, platinum and palladium. We either deliver them directly to clients anywhere in the world, or we store it within London bullion market approved vaults, again, in a variety of different jurisdictions across the world. The storage vaults that we use are London bullion market approved. They're stored on a fully segregated, fully allocated basis, and fully insured by the Lloyd's of London. And I guess what makes us uniquely different is the fact that we apply a consultative approach to clients buying or selling metal. We tend to have a vested interest in the performance of our clients' portfolios. And what I mean by that is the better we do, the better our clients do, the better we do in terms of our reputation. And the more you tend to see us in the top tier publications. So we often feature on CNBC, Bloomberg, BBC News as thought leaders for what we do within the space. And as much as we like to give guidance in terms of how to do this and why to do this, we often give guidance in terms of, when to do it or when not to do it, because there's always an optimum point in terms of when to purchase. And it's not so much about merely purchasing gold or silver. It's also about removing risk from a variety of different asset classes at the optimum point. So we often give timing in that respect, which would then seek to remove some of those risks while taking advantage of both gold and silver at the best possible price. The other reason why we are sought out by the professional market, the investment bankers, the accountants, the lawyers, who tend to want to purchase at the lowest possible price, but they often make a habit of removing any and all risk, is because we offer a buyback guarantee, which is particularly rare within our particular marketplace. And essentially what that is it's a guaranteed means of instant liquidity as of when a client requires it. Now, despite the fact that most people that purchase metals do so for the longer term today has a very different definition to what it did 3 or 4 years ago with the use of technology and globalization. Previously it would have been, 4 or 5 years plus. Now it can be anywhere from a year or 2 years plus. But our buyback guarantee works and is operative, immediately after you purchase. And it's important that clients understand that it's as liquid as any money or cash that you would have sitting in your bank account, but you're not exposed to some of the nuances that people are exposed to when they've got money in the bank, i.e. counterparty risk, inflation, low-level interest rates. But with your physical gold and with your physical silver, ideally you're growing your wealth in something that is physical, something that is tangible, something that tends to increase quite considerably in times of uncertainty. And if and when you need to liquidate, despite the fact that you can liquidate gold and silver anywhere in the world in any currency, we offer a buyback guarantee for convenience. So essentially that is what we do. And what makes us different is the fact that we do this based on relationship. We provide that consultative based approach. We get to really understand why people are purchasing for the reasons they are purchasing for. That allows us to provide, I guess, guidance in terms of effectively what they should purchase and when they should do it.
Now that's very interesting. I'd like to sort of delve a little deeper into that level of service, if I may, Josh. I'm a former bank manager, financial advisor, and international wealth manager. I've worked in Switzerland advising high net worth clients. And one of the areas where I differed from perhaps some of my colleagues is that I've always recommended to people to invest somewhere between 5 and 10% of their portfolio in precious metals, and preferably gold and silver. Most of my colleagues didn't do that because, of course, they weren't necessarily remunerated for doing so. Whereas if they offered bonds or some form of regular savings plan, they were paid very high levels of commission, and they were paid virtually nothing for recommending gold and silver. And so most of them just simply didn't do that. Now, of course, if a client came along and paid you on the basis of a fee as opposed to a commission, then sometimes that differed. So what you're saying is you don't, unlike perhaps most bullion dealers who will just say, this is my gold, these are my gold bars and coins, these are my silver bars and coins, you can buy them at this price, here's the website, buy it from here. What you're saying is you go into a more detailed consultative approach and perhaps look at their portfolio and judge whether their proposed investment is sensible or not. Am I right there?
Yes, to a point. And I think, it's really important to mention that we're not financially regulated. So we're not allowed to give financial advice. We're not allowed to assess a client's risk rating and say that actually based on their level of risk, they should be doing this or they shouldn't be doing that. Our job is to give as much procedural guidance with as many facts as possible about the market, about our product, about pricing, so that clients can make their own informed decisions. So effectively, we give the information, and it's for clients to decide what they think is relevant to them. And it's really important that, we're not seen as financial advisors, and we make that really, really clear. But I think it's a really interesting point you mentioned about the regulated market, because essentially, financial advisors have to take out insurance, professional indemnity insurance. And what we've found over the many years that we've been doing this is that, we tend to get a lot of financial advisors that will recommend clients to purchase through us. And I would say that a lot of those financial advisors that make those recommendations do so ethically. It doesn't actually come through that financial advisor. And when I ask these financial advisors, why are you not arranging the purchase for them as opposed to just sending them our way? And what a lot of them say is that they're not actually insured to advise on what they would call alternative asset classes. Now, physical gold, as ironic as it would sound, despite the fact that people have been using it for centuries as a store of wealth, is regarded as an alternative asset class in as much as physical silver is. And as a result of that, a lot of financial advisors, I would say 90% of them, they're not insured to give any financial advice on whether or not a client should purchase them. So in a way, the market is limited because they're only advising on the products that they are allowed to advise upon. And therefore, if they had to advise with their professional hat on, as opposed to their ethical hat, despite the fact the client wants to remove all and every counterparty risk, most financial advisors will turn around and they'll say, well, I think you should probably purchase a gold-backed or a silver-backed ETF, as opposed to, telling the client to go off and purchase the physical asset class, either on their own or through them. I think the other, once you get me started on financial advisors, and I know this is what you used to do, and I have some real respect for what you do, because it's a really, really difficult job. Some things you can control and other things you can't. And actually, some of our consultants used to be financial advisors in a previous life. If I ask some of our if I ask my clients, what their financial advisor's job is, they will tell us that, his or her job is to grow my stock portfolio as much as they can, right? And I would disagree. I would say that is not, their job. Their job as a financial advisor is clear. It's to attract balances to the institution to which they work, so to bring assets under their management. And it's to invest those balances in the market so that you can see it in the way they're paid. So most of these financial advisors, they're paid on assets under management, which means they get a percentage of the totality of the portfolio that they manage. And it varies, but most commonly it's about 1%. So, if we were to do a quick role play, right, and you're my financial advisor, I've got you're looking after about £1 million worth of my portfolio within the stock market. You're making about 1%. So effectively, you're making around £10,000 per year. Now, let's say for supposition, you're doing a really bad job. The market falls by 50% and I'm now down £500,000. Now, you're now earning £5,000 a year, right? So the idea is that as long as I stay in, whether I win, I lose, or I draw, you get paid. So what does it do? It creates conflict. Now, I've asked this question so many times that it becomes rhetorical, but I ask my clients, hey, did you get a call from your financial advisor before the crash in 2008 to say, look, I've looked at the charts. This thing doesn't look good. We've got to get your money out temporarily. And no, nobody got that call, not in 2008, not in 2000. And the reason for it is that for a financial advisor to call every single one of their clients and say, look, we need to get your money out for a while, it literally stops their ability to earn. It literally takes food off their table. So those calls didn't ever come. And this is what we tend to see happening. The market drops by 50%. People panic. They call their advisor to ask them what's going on. And everyone gets a version of the same line back. And it's something like this, well, this was a broad crash. No one could have seen it coming to the extent that it did. And now here comes the line. But don't worry, the markets will come back. I'm sure you've heard it, everyone has. It's a very common phrase. And you know what? They're right. When they say the market is cyclical, we establish that. By that definition, it's going to come back. But the problem is, it's going to be in 7 to 10 years. So you think about this game, the passive reliant individuals playing, you ride the market up every 5 to 7 years. You take 2 steps towards retirement, the market drops, you take 1.5 steps back, and you spend the next 7 to 10 years taking that 2 steps forward, taking 2 steps forward again. And it becomes this kind of dance, 2 steps forward, 1.5 steps back. Essentially, you're taking half a step forwards every 20 years. You're essentially inching forward over time. There's something, the reason I mention this is because we deal with a lot of investment bankers, a lot of hedge funds, and a lot of smart money clients. And the way that they do things is slightly different to the way in which a financial advisor would advise their client. And we can come on to that later. But I just wanted to kind of address the question of the regulated market in the way that we see it in respect of our clients.
Oh, that's great, Josh. And frankly, I couldn't agree more. I've now technically retired from that world, so I cannot officially give investment advice today. I did point out, however, to our subscribers that I have quite a reasonable pension fund, which is heavily invested in equities. And in December, I converted more than 50% of that fund temporarily into cash with a view to putting it into alternative investments or waiting until the fall on the equity market, which in my personal view is inevitable and so far has occurred to some degree, awaiting an opportunity to invest back in. But you're absolutely right. Financial advisors in the main do not actually contact their clients and say, oh, we think you ought to do this. In fact, what a lot of them tend to do is apologize for the decline in the portfolio and emphasize the fact that over the long term, equities will be perfectly fine. Don't worry. So you're absolutely right there. But talking on about investments, I'm going to play devil's advocate because gold is up just this week $70 and silver's up $1.40. Over the month, gold is up 9%, silver's up 15%, which is great. But if we look at a 10-year view, unfortunately, gold is up 17%, which when you compare that to the equity market, it's not good, in fairness. I think I'm right in saying Goldman Sachs claim that the average stock market rise per year is about 9.2%, and the S&P was over 13%. But silver's had a 23% fall over the 10-year period. So over a month, it's done well. Over a year, gold up 14, silver's down 1. But over 10 years, gold has done moderately, but 17% isn't something to jump up and down about. But silver's had a 23% fall. What say you to that?
Well, I guess I want to answer that with a question. Can I ask, are you measuring this increase in US dollars or sterling?
Yes. Good question. I'm measuring it in US dollars only because the majority of our listeners are from the United States. Having said that, we have a fair number coming from the UK, obviously from Australia, Canada, New Zealand, and other parts of Europe, with a few then further afield. I tend to price it in dollars purely because of the fact that commodities are currently priced in dollars. And I think I know where you're going to go with this, then talking about sterling in particular and how that's performed in other currencies. But by all means, keep this conversation as wide as you wish. But I focused on dollars, but if you want to widen that to other currencies, that's perfectly fine.
Well, we can start with dollars. I guess back in 2011, I remember back in 2011 in US dollars, we reached, I think we started at around the $1,370 an ounce mark. And if we're looking at today's price of around 1,941, I make that around a 41% increase. Obviously, 2011 was a very volatile year. We had a big range between the low and the high. I think in 1 year, in 2011, we saw an increase from 1,376 right up to 1,700. So I think, if we take the lower part of 2011, which was 1,376, and we take today's value, that accounts for a 41% increase in the value of the metal, which over 10 years is a 4% increase per year, which again, if you were to equate to inflation, it's exceeded inflation, which gold is supposed to do at the very, very least. But I get your point. I would say that compared to equities, it is probably underperformed. If you look at it in sterling, in the same year, 2011, the gold price was around £850 per ounce. And if we look at the gold price today at around 1,470, it's increasing at such a fast pace that I might be out of date based on me saying that. But broadly speaking, we're sitting at around a 73% increase over the last 10 years. And again, that accounts for, roughly speaking, a 7% increase per year. I would say that a lot of our clients are purchasing gold and silver for many more reasons than purely price alone. Effectively, our clients, and again, I mentioned this before, we service a lot of investment bankers, a lot of accountants, a lot of lawyers, because we get to speak to every single one of our clients. We really get to glean the underlying motivations for why they're looking to purchase. And when you've got the head of 3 different banks telling you that they're purchasing gold because they don't have much trust in retail banking, then it's a cause for concern. So I would say the number one reason for people purchasing physical metals is to remove a portion of their wealth from the banking system, from banks, from institutions, so that they've effectively got their own control, their own autonomy over their wealth. If we look at other reasons, we've got, we're sitting within a market that is riddled with uncertainty, full of unpredictability. And it's usually those sorts of markets that gold and silver tends to perform very, very well in. If we look at gold since the year 2000, we've seen, roughly speaking, a 500% increase in the metal. But again, most of our clients aren't doing it purely to make money. They're doing it as an inflation hedge. They're doing it to remove counterparty risk. They're doing it to obtain some sort of privacy within a market that is not private anymore. Purchasing physical metal, there's no requirement for you to register what you've purchased, where you purchased it from. There's no ledger that anyone maintains whereby members of the public can see what you own and what you have. And, that's become more and more of a factor, given that governments might decide, as desperate as they are, to wake up one morning and to slap a 40% tax levy on anyone that has more than a certain amount of money in their savings account. We saw it with Cyprus and Greece 5 or 6 years ago. And I would arguably say we are in far more desperate times today. than we were back then as a world, as opposed to individual countries. So I think that those sorts of things are real drivers. And I think the other thing to not forget is that purchasing certain types of physical gold, depending on where you are in the world, will reward you with tax advantages. So let's say for supposition, the equity market, which has had a great run over the last few years. And I think last year, within my pension, I received around a 10% increase in the value of my equities. My gold, however, performed far better than my equities. But on equities, one has to pay tax. And with physical gold, if done in the right way, you're able to avoid paying any tax, legitimately speaking, which means that if you're earning 9%, depending on your tax bracket, you might only receive net 4.5%. And if you're earning 7% on your gold, if done in the right way, you're earning 7% net. So I think it's important that if you're purchasing the right asset at the right time for the right reason, and if you do it in the right way, you're able to achieve all of that upside in the same way as you would do with the equity market. And I think I'm a big believer that I don't think that any one asset should compete with one another. This interview or conversation shouldn't really be about gold versus equities or gold versus cryptocurrency or gold versus oil, because I think that there is genuinely a need for every single one of those asset classes within a portfolio. I have equities myself. I have cash myself. I've got gold. I think, the crucial element in terms of determining how much of it you hold within your portfolio is timing. I think timing takes a decision to do something or not to do something, and it will turn it into a good investment or a bad investment. Clients of ours don't necessarily look at physical gold and silver as an investment, because effectively when people invest, they're assessing how much risk that they want to take on. And when people purchase physical gold and physical silver, essentially what they're trying to decide is how much risk do they want to remove from a physical context, if that makes sense.
Yes, indeed, it does make sense. And in part 2, we delve deeper and look more specifically at silver, why, according to Josh, it should be at least $100 an ounce today, and we discuss that all-important gold to silver ratio, further details of precious metal investments, and a new accumulator plan, which the Pure Gold Company has recently established. And if you want any further details on any of these, please go to the link we've put in the description box below or in the comment section, and then contact them either by telephone or email. Meanwhile, in order that you do not miss out on part 2, please ensure that you've subscribed, press the bell sign, and by all means do share your comments below. We will read them with most interest. Thank you once again for listening. Until tomorrow. Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.